Welcome to this explainer. Listen, if you're gearing up for the US CPA FAR exam, you already know the deal. The sheer volume of journal entries you have to memorize can feel like climbing Everest, right? But today, we're going to change how you look at that mountain. Let's dive right in and transform this overwhelming 100-entry study guide into your ultimate gamified playbook for crushing the FAR exam. We're going to break down the mechanics, clear out all the clutter, and show you exactly how to build the rock-solid muscle memory you need to pass. Here's our game plan for today. We'll start with the core FAR entry strategy, then nail down the basics of assets and liabilities. After that, we'll tackle the toughest boss battles, bonds and leases, move into advanced topics like consolidations and taxes, and finally, lock it all in with spaced repetition. Now, before we even look at a single entry, we have to talk about the absolute core philosophy of this guide. Keep your amounts as XX and strictly prioritize which account gets debited or credited. This is huge. When you're deep in study mode, it's so incredibly easy to get bogged down by the complex math of a simulation problem. The secret strategy here is to literally ignore the math at first. You want to focus entirely on mastering the debit and credit placements. Because think about it, if you know the structure of the entry perfectly, plugging in the numbers later is a breeze.
All right, Section 1, FAR 100 Entry Strategy. Let's get tactical.
This 4-step study loop demands your active participation. This isn't about just passively reading a textbook. This is a tactical workout. Step 1 is the blank paper method. You hide the answers, look at the topic, and physically write out the debits and credits from memory. Step 2, be absolutely ruthless and mark your mistakes. Step 3, mentally trace how that entry flows into a T account and how it ultimately hits the financial statements. And finally, Step 4, only then do you actually calculate that XXX amount based on the problem. This loop is what actively builds that exam day muscle memory. Let's see how this works in practice with Entry 1, Bank Service Charges. The guide completely strips away the noise. The pattern is just debit, service charge expense, credit, cash. The key exam takeaway here is that during a bank reconciliation, you only ever adjust the unrecorded items on the company's books, not the bank's. It's clean, it's simple, and it's totally ready to be memorized. Moving right along to Section 2, let's nail down the basics of assets and liabilities. A lot of this boils down to knowing your timing and your accounts. Notice the clear distinction between recognizing revenue from a standard credit sale, where you're debiting accounts receivable, and crediting sales revenue, versus immediately adjusting the inventory account under a perpetual system. In Entry 15, when you buy inventory perpetually, you bypass a purchases account entirely. You debit inventory directly and credit accounts payable. Locking in these basic timing distinctions early on is an absolute game changer for the larger problems. Now for receivables, the crucial point, which honestly trips up so many candidates, is all about anticipating rainy days. Under the allowance method, you estimate and record your credit loss expense at the end of the period. But check out Entry 9. When an actual write-off happens later, you just debit the allowance for credit losses and credit accounts receivable. Notice what's missing there? Yep, an expense account. You don't trigger an additional expense upon write-off because you already anticipated it. Memorize that pattern and you'll never double count expenses on the exam. Flipping over to current liabilities, your main job is to just memorize these specific triggers. If a problem mentions employees taking vacation, boom, immediately think of Entry 26, compensated absences. If a company gets cash before delivering a service, that's Entry 28, unearned revenue. And you always have to watch for recognition requirements. For example, warranties in Entry 30 need to be both probable and reasonably estimatable before you can even recognize that liability. Okay, warm-up is over. Section 3 brings us to the first major boss battle of the FR exam, bonds and leases. Let's look at the actual mechanics of bonds. When you issue a bond at par, it doesn't get easier. Debit cash, credit bonds payable. But Entry 46 for a discount bond is where it gets fun. When the market rate is higher than your stated rate, you're getting less cash up front. So you debit cash, but you also have to debit the discount on bonds payable to balance out that credit to bonds payable. It perfectly illustrates how a discount acts as a contra liability. Now, whether you're dealing with a discount or a premium, the single formula right here is your golden key. Under the effective interest method, your interest expense always equals the carrying amount of the bond multiplied by the effective market rate. The actual cash you pay out is just the face value times the stated rate. The difference between those two amounts? That's your amortization. If you burn this exact structural relationship into your brain, bond amortization tables will literally never intimidate you again. Leases are definitely another heavy hitter. Let's compare payment entries for an operating lease versus a finance lease. Both entries credit cash and debit the lease liability to knock down the principal. But look at the crucial difference in the expense. The operating lease records one single combined lease expense. The finance lease, on the other hand, explicitly separates out the interest expense. Nailing this difference is honestly half the battle when you're facing lease task-based simulations. To completely own finance leases, you really just need to view them as a three-step journey. Milestone 1, recognize the right-of-use asset and the lease liability the day it starts. Milestone 2, split your ongoing payments between the interest expense and reducing that liability. And Milestone 3, do not forget to amortize that ROU asset, which is usually over the shorter of its useful life or the lease term. Memorize these 3 milestones, and you're golden. You're doing great. Let's push into Section 4. Advanced topics, where we tackle consolidations and taxes. So what actually happens when you buy an entire company? The acquisition method can feel like an absolute monster the first time you read about it. You're trying to merge two totally separate sets of books, adjust things to fair value, and make sense of whatever numbers are left over. But when you distill it down to its core journal entry pattern, it's really just a massive balancing act happening on a single date.
Take entry 94, your ultimate consolidation template. You're debiting the sub's assets to fair value, wiping out the sub's old equity, crediting liabilities to fair value, removing the parent's investment account, and establishing the non-controlling interest. The massive takeaway here is that goodwill is literally just your balancing figure on the debit side to make this whole giant entry work. Seriously, write this template out 5 times on a blank piece of paper, and the logic will just click. Now, once you combine the companies, you absolutely have to eliminate internal group transactions. You can't owe money to yourself, right? And you definitely can't sell things to yourself to magically boost profits. You've got to eliminate the big 3: intercompany payables and receivables, intercompany sales and COGS, and most importantly, any unrealized internal profit just sitting there in ending inventory. Remember, profit is completely unrealized until that inventory is finally sold to an outside third party. Moving to deferred taxes, another classic FAR stumbling block. But it really comes down to a simple, clean comparison. You just have to keep your timing differences straight. If a temporary difference means you get to take a tax deduction in the future, it creates a deferred tax asset today. But if it means you'll owe more taxes in the future, it creates a deferred tax liability today. Future deductibles equal assets, future taxables equal liabilities. Just repeat that mantra to yourself. All right, final section. Section 5 is all about spaced repetition for total, complete mastery. You can't just write these entries out once and pray they stick. You need a schedule, and the spaced repetition calendar is the secret sauce. When you miss an entry on your blank paper, you mark it. Then you absolutely must retest yourself on that specific entry the next day, then 3 days later, and then 1 week later. This forced recall at very specific intervals is scientifically proven to lock these patterns into your brain permanently. And while you're grinding through that schedule, never forget the golden sequence. Never look at a journal entry in a vacuum. When you write down a debit and a credit, visualize it. Trace it all the way through the T account. Ask yourself, okay, did assets just go up? Did net income just drop? Understanding how a single entry shifts the final financial statements is exactly what separates a passing score from a failing one. Now, one massive caveat here. This playbook gives you an unshakable structure, the core debits and credits. But on exam day, those XXX placeholders go away. You still have to read the actual exam text carefully to calculate the right amounts, judge the recognition dates, and apply whatever specific rules they throw at you in the simulation. These patterns will give you incredible speed and confidence, but careful reading is what gets you those final passing points. So, we've walked through the whole shebang: the strategy, the basics, the boss battles, and the retention plan. You've got the conceptual playbook for all 100 essential patterns. But here is the ultimate question. Are you going to conquer the mountain, or will these 100 entries conquer you? Grab a pen, hide the answers, and let's start building that muscle memory today. Your CPA credential is waiting for you. Thanks for hanging out with me on this explainer, and happy studying.